Good evening and welcome to this very special episode of The Money Show. I'm Kavita Thapliyal and this is a show, War of Asset Classes. That's right, that's what we are calling it. And who will win 2026? Now, 2025 has been a year of sharp contrast for global and Indian markets. Now, while some asset classes struggled to find the right direction, others delivered surprising returns, testing investors' patience, conviction, and strategy. Now, geopolitical tensions, trade tariff uncertainty, global macro risk kept markets short on clarity and long on volatility. Indices broke key support levels, struggled to hold higher grounds, and failed to show sustained strength at upper resistance zones. Now, equities for much of the year delivered returns closer to fixed deposits, but SIP investors emerged as the real heroes while, systematic investment flows hitting record highs every month. Now, sector churn dominated headlines definitely, and a renewed push towards the consumption theme caught investors' attention. Now, debt markets, after years of tight monetary policy, finally found some relief. We are now clearly in a rate cut cycle with expectation of more easing ahead. However, bond yields and persistent rupee weakness remains key risk, a trend that could very well continue in 2026 as well. Now, but the real jackpot asset class in 2025 were elsewhere. That's right, gold and silver shone bright amid geopolitical uncertainty and aggressive central bank buying. Gold scaled fresh highs and silver as well on an even stronger run. That's what we are witnessing, triggered serious FOMO among investors. Talking about cryptocurrencies, staged a dramatic comeback, ETF approvals and rising institutional participation pushed Bitcoin and digital assets sharply higher, delivering stupendous returns in 2025. Now, once again, crypto reminded investors why it is the most volatile yet most tempting asset class. But then there's passive investing. Index funds and ETF quietly outperform many active strategies, capturing market returns efficiently, transparently, and at a low cost. So as we step into 2026, the big question over here remains: which asset class will lead the race next year? Will equities make a strong comeback? Will fixed income offer the right balance of return and safety? Will gold and silver continue to shine, or will crypto surprise everyone yet again? Now, to decode this battle, we have an exceptional panel with us today. We are joined by Mr. Sandeep Bagla, CEO, Trust Mutual Fund; Abhishek Hussain, Head of Fixed Income, Kotak Mahindra AMC; Ajit Khurana, founder Reflexical; Dharmesh Bhatia, commodities expert from Dubai; Chintan Haria, principal investment strategy, ICICI Pru AMC. So 1 hour, one debate and one winner. Hi, good evening. Welcome all of you. And this is the War of Asset Classes 2026 and we begin right now. Dharmesh, now a view from you, because definitely gold and silver needs to be in your portfolio. One can look at 10% or maybe, up it up, step it up a few more percent also. But then having said that, the right way to invest, would you prefer multi-asset allocation fund, Dharmesh, or a pure ETF should be in the portfolio?
So what Chintan said, I completely agree. The portfolio has been reduced. Even for 2026, our house view has reduced from 20% to 10% for the precious metals. But what we have done is multi-assets will be a better choice for the staggered investor, ultra HNI clients. What we service, we tell them to diversify their portfolio in each and every asset class in a very minimalistic way, depend upon the cautious or adventurous client's portfolio. But currently, what we are looking at is diversifying the portfolio to a better yield, which is because the yield is coming down in the international market, especially on the treasury yield. So you will see the bond market to pick up very sharply. Other than that, we are very bullish on the gas side also. With rate cuts, liquidity in a very highest level liquidity will be there in the market. Industrial demand will pick up very sharply. As you can see, silver is a 50% bullion and 50% base metal category, and it has shown a sharp rally. Copper has rallied, zinc, aluminium, nickel, everything has rallied to a lifetime high. So the only commodity which is left is oil. And I'm expecting that definitely the oil will be the next year will be a black horse for the commodity side, and it can run up at least 20 to 30%, because industrial demand will pick up in this stagnant manner. Other than that, if you see euro and sterling as a currency basket should be also considered, because it has been depreciating continuously for last 3-4 years, and then this year they have shown some kind of a green signal where market is showing a positivity. So euro and sterling as a currency basket will also be into an asset class. You can see. So short to medium term, I'm really bullish on the market, especially on the oil side. And regarding gold and silver, definitely you should have 5% gold, 5% silver in the category. No doubt, platinum, palladium has rallied only 100% this year. Especially platinum last year was trading at $1,000. This year is almost reached $2,000. It used to be higher than the gold price, but currently because of the industrial demand, the price has picked up. But again, the volume and the volatility is very narrow down compared to silver and gold. But it can be into a basket where the price can rally maybe $2,500 to $2,800 in coming years. As other panelists said, during the Hunt Brothers time, silver was at $50, and now it has crossed the $50, and it is a benchmark for the silver price. So you can expect maybe in coming quarters there could be a profit booking, but again the benchmark has stayed very high, and you can expect the rally to continue in case if the interest rate keep on depreciating and the demand of industry and the commodities will keep on rising. So I'm overall bullish on the commodity side for 2026.
But a question that I will come back on later on is whether should we considering gold and silver as core of your portfolio and not just considering them as hedge against inflation. Now that we'll talk about later, but then let's come back on the fixed income side. And Abhishek, I want to ask you, or maybe help our viewers strategize their placement as far as fixed income is concerned. Now, what products are we looking at? What kind of time horizon are we talking about? Fixed deposit, people are still interested in investing for a longer term, considering fixed deposit for that particular purpose, for parking their money there. If we talk about debt mutual funds, what other products and papers are we talking about here?
Yeah, so good question. Actually, when the fixed income comes, the tax element becomes a very critical part of the overall returns basket. So irrespective of whatever returns you generate from the fixed income, if you are in the highest tax bracket, a significant portion goes in the taxes, and which is normally ignored by the investors. So for that, there's a new category which has emerged, and which is a very good category from the tax and the overall stabilizer portfolio point of view is income opportunities and arbitrage as a hybrid product, where you have 60% debt and 40% into equity arbitrage fund. That is yielding on a YTM basis close to around 7%. And given the way the liquidity and rate structure is, you are likely to get somewhere on ITM if you are able to hold the portfolio for more than 2 years. That is the caveat there. So if you are able to hold that, then you are able to go from straight from the 40% tax bracket to 12.5% tax bracket, and you are able to generate that kind of alpha from this arbitrage. And as far as overall fixed income is concerned, please take it as a stabilizer to the portfolio, because we are in extreme volatile and ambiguous situation where everything is all over the place. As other panelists also suggested that you should be around 5 to 10% in your asset allocation as far as commodities are concerned. So if you stick to that, then probably you should be looking to book profits. But actually in reality, we see things happening the otherwise. People are still looking to add significant amount of weightages on the portfolio in purely in the commodities because of the past 1 year significant stellar performance. There is value in equities, there is value in fixed income, especially in the longer end. If you are able to do this relative trade, probably the next year, equities and fixed income both are likely to give you much better return relative to the commodities, is what I wanted to highlight.
Ajit, with so much of adoption of crypto worldwide, what are the regulatory announcements that you would expect either in budget or maybe, entire 2026 that you really want to see happening?
From the investor's point of view, the biggest pain point in India is that crypto is taxed far more adversely than literally anything else. Like, for example, you pay 30% tax on profit, which is okay, but then you can't set off losses. I think just imagine that. So I think that some normalization of taxation, making it comparable with other assets, even risk assets, that is not a problem. On the provider side, there's a lot of room for regulatory improvement, because this is where all the problems occur, and this is where you can actually have broad and sweeping regulatory improvements. AML, KYC is already already done pretty well in India. The financial intelligence unit takes care of that. But as far as reporting, as far as market participation, market depth, order book maintenance, etc., unlike some of the better jurisdictions around the world, such as England, Switzerland, Singapore, America, India has no regulations on that end. And given that the regulations' significant objective tends to be consumer protection, we are just really hoping that the founders of these exchanges are really doing a good job. And frankly, a lot of them are. But it would be good to have some regulatory clarity on that.
Absolutely. Sandeep, coming back on the equity market, I really want to understand how are you looking at the IPO frenzy out here? What's the fund house take over it? How are you looking at, and what will be the word of caution as well for the viewers and investors?
So I had read a report recently that there were multiple IPOs in the past also, and some of those companies disappear from the market because of poor governance and non-adherence to listing agreements in the subsequent years. So I think any market which is growing has those risks. So which is why I think individual investors are better off investing with professional fund managers in equity, AMCs, PMSs, AIFs, whatever formats they might like. So we are, India is a growing market. I think India will grow at faster pace than any other country for the foreseeable future. And more companies will get listed, more sectors will become bigger, thereby providing investors opportunities to participate. So I think IPO market is more than welcome that Indian investors are getting an opportunity to participate and invest in IPO markets. But I think one has to be careful. And typically, whenever we move from absolute valuation comfort to relative valuation benchmarking, there is a fear and it's a real danger that companies which are getting listed at high valuations might not perform for a few years to come. So one has to be careful, one has to be choosy. And I think while the widening of the IPO market is welcome, one needs to trade the IPO market with caution.
That's the word of caution coming in from you. But then, Chintan, I'll come to you because a very important question. Do we still treat gold and silver, or maybe gold mainly, as hedge against inflation, or it's something that needs placement in your core portfolio? We cannot treat it like the way we used to.
So I guess gold has stood the test of time for thousands of years, and it does have a long lead time in terms of the time it underperforms after extreme outperformance. So if you look at it, 1970 to 80, $40 to $600, then 1980 to 2002, $600 remained there till next 22 years. So what happens essentially is that people believe, and this of course is in dollar terms, rupee having depreciated every year against the dollar. In India, we have never actually seen that kind of pain in gold. But if you look at international markets, for 20 years between 1980 to 2002, 22 years, the gold did not perform, and hence people started believing gold is not a good asset class to have. And of course, those who can pick stocks well, there will always be good stocks which will do better than gold, and if you have a portfolio. But for most of us, and especially in a country like India where rupee does end up depreciating, I don't know whether it will depreciate from here on because we've gone from overvalued to undervalued in the last 1 year. So maybe there is no depreciation expectation in the next 1 year. In fact, I think the previous speaker was speaking that in the next 1 year, we will see Indian rupee probably being stronger, debt markets performing better, equity markets performing better, foreigners hopefully coming back, because of all the noise that we have, foreigners are left with only 70 lakh crores of Indian equity with them, 72 lakh crores. So, which is not significant. It's only 16% of our overall market. So that's something we should keep in mind. And today mutual funds, total mutual fund ownership is much larger at 80 lakh crores, including debt. But equity mutual funds itself account for more than 50 lakh crores. So today there is no worry of foreigners as such. So from a gold and silver point of view, from coming back to your question, they were always, and in time immemorial, being used as a hedge. They are also something where we should remember that if dollar loses its value, and at some point of time, it may become a currency which is no longer a reserve currency based on whatever we are seeing in terms of all the countries selling off the US bonds. At some point of time, there will be an alternate. What would be that alternate? We do not know. But the way to hedge against that is gold and silver. So while last 1 year, and in fact, if you look at last 10-year return now, gold, silver followed by gold has been the best performing asset class, followed by India large cap, then mid cap, etc. in India. So I'm talking about the asset classes which generally Indians invest in. So it is a core part of your portfolio. It was a core part of your portfolio. It should be a core part of your portfolio. The question is how much of it. And earlier there was no silver ETF, so it was probably not easy to put money in silver. Today it is much more easier to put money in silver. But having said that, when something goes up the way it has gone up, we need to be careful of how we time our entry. So gold and silver should be a very core part of your portfolio. Whether it is 10%, 5%, you decide as per your risk-taking ability. But I would say 10% in gold and silver is not going to hurt along as we move on. Thank you.
Right. Now, one last round of question, and this is going to be the same for everyone. The question is, now you guys are very experienced and you have seen multiple cycles of your particular asset class that you're representing on the panel today, and probably more than what our investors or our viewers have experienced. So I want to understand, what is that one thing that you have learned in 2025, something new, across your experience. And I'll start with Ajit first. Ajit, what's your new learning of crypto in 2025, something that you never saw, and maybe this was something that you want to maybe implement in your portfolio as well?
So I'm an investor in all the asset classes represented on this show, and then going beyond that also, like real estate or what have you. Right? Having said that, I must tell you that every asset class has its distinct characteristics. This I learned 10 years ago. This year, 2025, my attitude as well as learning towards crypto has evolved, not changed, but evolved only in one way, that until last year, that is until 2024, I would not see the yield generation possibility, and only hope that through my study, knowledge, opinion, whatever, I would have huge capital gains. 2025, I have also started putting a lot of emphasis on yield that can be generated, because now my crypto portfolio is relatively stable and my holdings tend to be multi-year holdings, and hence yield also matters. This is my new learning for 2025.
Sheikh, what would you like to say about the fixed income market now?
Yeah, so it has been a classic year for fixed income, where we believe that there has been immense amount of value in fixed income. However, that value kept on increasing. So there was a clear case of market risk, which triggers very rarely, and this was one of the year where it got triggered. So extreme positioning creates such kind of issues. So one should be very careful in terms of extreme positioning. It should not remain in your portfolio. You should remain very well diversified, and some amount of caution needs to be there at all point in time.
Dharmesh, your view?
So for last 20 years, I'm tracking the commodity market, and what I have seen in last 3-4 years is phenomenally on the war side. So when I saw a war happening, especially on the geopolitical tension happen, the central banks started moving their assets from currencies. As Chintan clearly mentioned about a dollar, the dollar has moved especially towards the gold side, and the amount of central bank, the gold has been purchased, that triggered the price. And as you see, the price has slow and steadily started moving. So whenever I see such kind of volatility, I expect that there is the central bank buying, because an individual or a retail player cannot move such kind of volatility in the market, and price rose almost 100% up. So this is a learning curve where when central bank starts purchasing some kind of assets, definitely it can be a stable market, will be stable and will go up the tick.
Chintan, your learning?
So if we look at from a new learning perspective, I would say that the sheer power of collective was showcased in India in terms of the SIPs. Every year we expected that if markets go flat or downwards, we will probably see SIPs slowing down, but neither the count nor the absolute amount every month is coming down. So the power of the collective, and I think the sheer force with which collective can support an economy and the markets is something which would be new. And of course, while it is not new, but the ability of gold and silver to outshine other metals or commodities, especially when times are uncertain, was again reiterated in 2025. It happens rarely. It happens once in 2 decades probably, but then years like 2005, 2010, 11, even 1990, of course, I was not in born, but 1980, I was not in born, but those years come. But when they come, they do probably make up for many years of past underperformance. So that's also something which, at least for newer investors in the last 10 years, is something which is new and new for me as well.
Sandeep, what about your learning?
See, I think the learning was multifold. I think,
Okay.
many a years, many a times we hear it's a stock picker's market. And I think this year was clearly that even in the wide space of small and mid caps, the performance of different fund houses in different portfolios was very different. I think we also learned to be nimble because sometimes the markets go up, but the gains are not sustained if earnings do not really follow up. And I think one learning is that one should be properly asset allocated with the help of a distributor, because while equities will do well in the coming years, the importance of other asset classes should not be forgotten. And the protective asset classes, new asset classes have emerged like REITs and InvITs, which have also done well, which is not find mention in today's discussion, but they have also performed really well, and I think they should be a part of the investors' allocation as well.
Absolutely, that's a true meaning, of diversification we talk about across asset classes. But we just hope that our viewers learn from your learnings and have a wonderful portfolio as far as 2026 is concerned. Thank you so much, all of you, for being on the show and helping our viewers strategize their portfolio and investments this particular year. Thank you so much for joining in.
Co-powered by Bank of Baroda.